Hi, we're having a conversation with Dr. Gerald Dwyer. He is director of the Center for Financial Innovation and Financial Stability at the Federal Reserve Bank of Atlanta. Dr. Dwyer, stability, when one thinks about stability, thinks about no changes. And how does that combine with innovation?
Well, I think it's very important. I mean, obviously, at least in the U.S., there's going to be a lot of regulatory changes as a result of everything that's happened. And it'd be very easy to put in place a bunch of regulations that would prevent any bad things from happening, but they would also prevent any good things from happening at the same time. I mean, one of the contributors to the financial crisis is new derivative securities. And so it would be very easy to say, well, we just don't want any new derivative securities, or we don't want any new securities at all. And you'd basically shut down all the innovation that we've had, which actually has been very positive in general. And what happens when you have this kind of innovation is lots of times is something happens that nobody really thought of, which is partly what's happened now.
And of course, one could say that another element that was important for the crisis was the mandatory lower interest and the mandatory credit for people, subprime.
Yeah, there's the question about, I get this question actually, so what caused it? You know, in the U.S. it's like, who are we going to burn at the stake? And so the way I think about it is the following, is that the two major contributors really were the following, I think. One of them is that the federal government basically mandated that Fannie and Freddie, two U.S. government-sponsored enterprises, whose securities were perceived to be and have been guaranteed by the U.S. federal government, were basically required to buy subprime mortgage securities. That increased the demand for these securities. Basically what that means in terms of securities is that people who were getting subprime loans were able to pay lower interest rates than they would have otherwise. So it made it more attractive to borrow that way. And that definitely contributed to the problem. Something else that's related, and it's related to the name of the center I run actually, is something related to that, although it actually predates it, is what's called structured finance. And basically what that means is you go out and buy some securities and you create new securities based on them, and then issue them, collateralized debt obligations based on subprime mortgages actually. And this is partly how, I just finished a review paper on this stuff. And so there were like 4 townships, they're called, in Norway, that were holding pieces of collateralized debt obligations. They were AAA rated, and so they thought they were all perfectly fine. What happened is the subprime mortgages started not paying. People got worried about them, and their value went down a lot. And so this was actually very bad for these towns, because apparently they held a lot of this. One of the things that happens with these securities, it's curious in a way, is when we teach finance, one of the advantages of creating a lot of securities is you can spread the risk around. So that instead of the original lender of the mortgage bearing all the risk all by himself, you can sell the risk off and everybody holds a little bit.
Dispersed.
Yeah, it's all dispersed, and that's a good thing. But one of the consequences too is when things go bad, one of the things that's happened is it shows up in lots of places you might never think of. Like 4 little townships in northern Norway that because the value of these subprime securities went down, then they suffered big losses, which was very problematic for them. There were a couple of banks, a couple of state banks in Germany that failed because of this actually. And so the risk gets spread around, and you see a lot of different people holding different pieces of it. And so arguably one of the issues with the crisis has been figuring out who holds all these different securities. Now, part of what's related to these collateralized debt obligations too is whether the prices initially actually reflected the underlying risk. One of the things that I think happened, and there's some evidence to suggest this, is when these securities are created, there are different pieces, and they have different ratings by U.S. rating agencies. So you can have a AAA piece and a AA piece and all this other things. And the way people interpreted it was, well, a AAA collateralized debt obligation is basically the same as a AAA corporate bond. Cool, it's really low risk. Well, if your security is backed by subprime mortgages, it's really not the same as owning a bond that was issued by IBM or some other very highly rated, very large corporation that's very unlikely to fail. Now, so those were two parts of it, and I think they were the most important parts personally. Now, the other thing that you mentioned that people will mention is that the Federal Reserve held interest rates low for a little while. And at this point, I should say, I could have said it earlier, is any of the opinions I'm giving are mine. And so it's not the case that I'm representing some official Federal Reserve position, nor do I feel compelled to defend the Federal Reserve. Because I work there, but that doesn't mean I'm the chairman or anything like that. I'm not. So the Fed kept interest rates low for a couple of years in the early 2000s. That's true. Now, what that did in terms of the U.S. mortgage market is it made it more attractive to get an adjustable rate mortgage than to get a fixed rate mortgage for a while. Now, it's quite possible that some people thought those interest rates were going to stay low forever. But if anybody who looked at the markets, or anybody who thought about it for a couple of minutes, would realize that they're not going to stay at 1% forever, that they're going up, that you're going to get this low rate initially and they're going to go up. And so the only people who got into those kinds of mortgages thinking the rates, if they got into them thinking the rates were going to be constant, it was stupid. That's the only way to characterize it. Now, and so the question then becomes, well, how much of this stupidity went on? You know, the way I think about it is stupidity is ubiquitous. It's all over the place. There's no doubt about that. On the other hand, explaining some very large development on the basis of people were stupid is not very satisfactory, because most of what people do isn't stupid. And when people get mortgages, those are really important decisions. Actually, there's another problem with that argument that I have to mention, which is the rise in housing prices was worldwide. Prices in Sydney, Australia rose a lot. Prices in London rose a lot. It's hard to think of Alan Greenspan did it all by himself, you know. I mean, being chairman of the Federal Reserve may make you powerful, but it's not obvious it makes you that powerful. So that's why I discount that particular explanation. I'm not saying it didn't contribute to it. I would be surprised if there weren't some people who got into variable rate mortgages and thought the interest rate would just stay there forever and not realize it's just a teaser rate and short-term interest rates are only temporarily low.